webinar, The Taxman Cometh Property, a Tax Treat or a Tax Trap. So I'm really looking forward to tonight's webinar. Taxation affects all of us, both business-wise and personally. So I know we've got some really first-class speakers on this evening. We've got John Woolley, of Technical Connection. John is the director of the company, a firm which supplied tax and technical advice within the financial services sector for more than 30 years. He's also a divisional director of St James's Place Wealth Management. John has several legal and tax qualifications, including being a qualified TEP. He has been involved in financial planning in the financial services sector for 30 years. He regularly contributes articles on tax planning to various journals, as well as making guest attendances as a speaker of financial services and tax conferencing. He is an author of Financial Planning with Trust, published by Claritex. John's experience and technical know-how have made him invaluable first point of contact for many clients of Technical Connection Limited. And then we have Mark Quaye, sorry, of Marque Wealth Management, where he's a director. And after working in the banking, financial services and wealth management since Adam was a boy, that's his words, Mark established his wealth management practice in 2013, and as director accepted an invitation to join St James's Place Wealth Management in 2015. Prior to this, Mark had been practicing as an IFA for over 20 years. He has developed strong working relationships with accountancy and legal professionals and their clients. He has an interesting range of successful private and corporate clients that ensure he's constantly kept on his toes. Key areas of work involve investment management, estate planning, and pension analysis of occupational and personal arrangements, along with thoughtful interaction of this planning with other tax strategies. He's a member of the Chartered Insurance Institute and the Personal Finance Society. Outside of work, he aspires to be the new armchair manager of Tottenham Hotspur. So we can't have everything. So welcome to our speakers this evening, and I'll hand it over to them.
Great, thanks, Ian. So thank you all for coming today. So Marque Wealth Management works very closely with BACFI and the BACFI membership. So Ian very kindly asked for us to do a little bit of a presentation, and we thought the subject of property would be quite appropriate. I think a lot of us recognize the British, I don't know if it's the British fascination. We have got this love of property and legislation has changed massively, and we know the Taxman Cometh is really just saying, you know, we have mortgaged the future, haven't we, in this last 12 months by trying to keep UK PLC afloat. And so Marque Wealth Management in its financial planning is really aware that clients need to step back a little bit. A lot of you will have portfolios of properties, perhaps you're reluctant landlords or accidental landlords. So planning is what we're trying to draw attention to this evening. And John is, this is very much his specialism. So he's a great speaker. Obviously we are a little bit geekish, so I do apologize for the fact that this subject excites us, might not excite you, but I'm sure out of it, it will raise some points that you may want to follow through with us. And these details, I'm assured by Sandra, will be on the website for you to follow through and give us a ring so that we can support and assist you. But let me introduce, or let John introduce himself rather, and let him take the presentation forward.
Fine, thank you, Mark. So we're going to follow Chris Whitty's initiative here. So next slide, please. And I hope my slides are a bit clearer sometimes than Patrick Valence's that sometimes get a bit cluttered. Anyway, what we're going to be looking at this evening is property, and really looking at property from a tax perspective to decide whether it's still an attractive investment. So next slide, please. And I suppose, why is this subject relevant? Well, it's a fact, and we're quite peculiar in a way, that the British love property investments, and they always have done. And this is borne out by some of the facts here. 1 in 10 British adults own a second home. Some of that is because they've chosen to buy it, or they've inherited it, or they haven't been able to sell a property. Many property purchases are made as part of retirement planning. So quite a few people still take the view that property should be an investment that's used to provide for their retirement, their pension provision, if you like. But something that's happened over the last 5 or so years is that tax has become more of a concern for the property investor. So we had some tax changes back in 2015 originally, and we've had a trickling of other tax changes which have quite a considerable impact in this area. So moving on then, what sort of property will we be looking at as an investment? So next slide, please. Well, first of all, we've got the principal private residence. Now, technically, that's not an investment because we live in it, but it can be used as an investment, particularly in later life, for scaling down and investing any surplus. There's the holiday home that people might use 6 weeks or 8 weeks a year. Otherwise, it's just let out, or perhaps it's not let out and it's just kept there for the owner's enjoyment. There's furnished holiday accommodation, which is a form of buy-to-let, which people use when they go on holiday. It doesn't have to be by the coast. It can be anywhere in the UK. And provided you abide by the rules, that will be taxed as if it's a trading business, by and large. So that means you'll get special tax concessions there. And then finally, there's the buy-to-let investment, where you're buying a residential property and letting it commercially. And that's really what I'm going to be concentrating on tonight. So in the next slide there, you'll see some facts about the buy-to-let market, which are quite astonishing, really. 2 million buy-to-let landlords own 1 in 5 of all UK residential properties. The amount that's owned and invested in BTLs is enormous, £1.29 trillion. There's still going to be a continuing demand for BTL going forward because there is housing shortages, and it's so difficult for youngsters to get on the housing ladder. We've got more accidental landlords these days, and that's people who perhaps want to move house and decide to move house but are unable to sell their existing property. So that property is let out, and so they become an accidental landlord. Or quite often it might be somebody who inherits a property from a family member on their death, and they're unable to sell it, so eventually they end up letting it out. We're seeing more company ownership now because there's tax breaks for companies owning buy-to-let properties that individual owners don't get. So we're seeing more of that. And I think it's fair to say that property is an essential part of a balanced investment portfolio. However you regard that property, whether it's a property you own or it's a property that you indirectly own through perhaps a property investment fund, it's important to have that exposure to some element of property. So moving on, the next question is, why do people invest in buy-to-lets? And I think there's 3 reasons. One is to boost their income, to give perhaps a supplement to their earned income, self-employed income, or perhaps they're running a buy-to-let business, so that is totally their income. Others investing for capital growth with a view to selling at a later date and enjoying a tidy capital gain at that time. And others who, as I said earlier, may be thinking about their buy-to-let investments as some form of retirement provision, as an alternative or an addition to using a pension plan. And we'll come back and touch on that later on. So if we look at the returns on property, how has property fared? Well, there's been good long-term capital growth over the last 20 years. You may remember Tony Blair's theme in the election of 1997, things can only get better. In fact, I suppose the current Prime Minister may be thinking that at the moment, or hoping for that. But the fact is that if you invested in residential property in 1997, things did only get better, because property prices in London and the South East are up about 5 times compared to what they were then. We've also seen increases in rent over the last 5 years. There's been obviously a bit of a blip during the lockdown period, and we're going to have to see how that shapes up, I think, in a year or two. But we have seen a recent dramatic growth in property prices, and this is down to the fact that we've had this stamp duty holiday boost. So no stamp duty on the first £500,000 of a purchase, although the 3% surcharge still applies. We've got a big COVID catch up because a lot of the house purchase industry closed down really during particularly the first lockdown, and that's still catching up. And of course, a lot of people are now looking at purchasing residential property in the country as part of moving out of the city and as part of the working at home culture. It's interesting that in Newquay, we've seen a 15% increase in property prices in the last year. And in February, the completed sales in property in the UK were up 50% from February 2020. So that gives you an idea of the current momentum in the property market. But I suppose the big question is, will it continue? Will that momentum continue? And if you look at the next slide, there's a number, the next slide, in fact, there's a number of issues that do provide a degree of uncertainty. We've obviously yet to come to the end of the furlough period. But when we do come to the end of the furlough period, we will inevitably see some redundancies at that time, which may mean it's more difficult for tenants to find the rent they have to pay to their landlord. So that will create a bit of uncertainty. Will landlords be able to get quality tenants in their place, or are they going to give these existing tenants rent holidays and keep them on because they've been good in the past? We're going to see the end of the stamp duty holiday concessions. So that will finish eventually in September 2021. And so the market will readjust at that time. I think also we're going to see less landlord control going forward as the government brings in legislation to control when landlords can evict tenants and when they can't. So there's a lot that we don't know about going forward in terms of how these changes will affect property prices and the ability to get good tenants in. But there will undoubtedly still be opportunities. So I'm just going to ask you now, I mean, is there anybody who's on this call today who owns or is thinking about buying a buy-to-let? And if so, are you optimistic about the future? Are you concerned about any of these uncertainties? You don't have to answer that question, but I'll be very interested to hear any comments. Any comments at all? You don't have to. We'll come back and have a little question session at the end.
Yeah, what I would say from my experience with clients, some are having issues with tenants now, and they're having to navigate the yields, going down.
Yeah.
Is that something that you've come across with with the last 12 months?
Oh, so we have got somebody here who wants to. Is that somebody who wants to ask a question? Raise your hand to answer. Oh, right. No, it's just a note going out. If you want to ask a question, just raise your hand. I think that's a very good point, actually, Mark, because I think the issue there is, do you stick with your current tenant that you know and perhaps give them a rent holiday, or do you serve eviction on them? It's quite difficult actually to evict tenants at the moment, as you know, because of the government controls that have come in. And so there's going to be a number of landlords who are faced with that, because if a quality tenant goes because they're unable to meet their rent at the moment because of circumstances outside their control, you're then looking at trying to get someone in as a replacement who's got the same quality. And whilst you're doing that, of course, you're losing rent. The other thing that's happening, though, I think, is that because house prices are going up so rapidly at the moment, it's going to make things even more difficult for the first-time buyer. So that will fuel the rental market. So as we come out of this, there'll be more people who want to rent because they can't buy. Although the government have made a few initiatives available there, you know, with the 95% mortgage guarantee, but those are probably, you know, it's a little bit early to comment on how effective those will be. So if we move on to the next slide, then let's look at the tax changes and how those have affected the buy-to-let market. Now, these changes were originally announced by George Osborne in 2015. And his intention there was to slow down the buy-to-let market and get control of prices. And the main areas we had changes there were in wear and tear allowance, stamp duty on purchases of additional property, mortgage interest tax relief, and capital gains tax. And as these bed in, next slide please, it's pretty clear to us that it's very important that if you're going to combat these tax changes, you have to make tax planning in advance. This is as portrayed by my plumber friend in Swanage. So it's all about advanced planning. And if you do that planning, it can avoid some of these tax problems. So if we move on to the next slide, wear and tear allowance, you used to get a wear and tear allowance of 10% of rental income. So it's very simple, no science in it. Now you only get wear and tear allowance based on actual expenditure on replacement of furniture. So probably less tax relief, more emphasis on clients keeping records so they can claim that relief when they submit their accounts. Moving on now to stamp duty land tax. We had there the announcement by George Osborne of an additional 3% stamp duty over and above the normal rates for anybody who bought an additional residential property over £40,000. Now, the key thing to note there is husband and wife are treated as one unit for these purposes. So if husband already owns a property and wife acquires another buy-to-let, then the 3% surcharge will apply because husband and wife are treated as one in that situation. Now, if we move to the next slide, you'll see here that these are the rates that will apply when you purchase an additional residential property. So we're getting up to some quite substantial amounts, 8% on the portion of up between 250,000 and 925,000. So that is 3% over and above the normal standard stamp duty tax charge that will apply at the moment. And in the next slide, you'll see that this applies to a range of properties, including obviously buy-to-lets, holiday lets. It will also include property that a parent purchased for a child if the parent leaves his name on the title deeds, which some do because they want to keep some semblance of control over the property. There's an exclusion though for caravans and houseboats, so that's good for me because I've got a caravan down on the south coast, and also granny flats where the value attributable to the granny flat, which is part of a bigger property, doesn't exceed 30% over the overall value. Another concession that applies is when somebody sells their main residence and is moving into another property, which will be their main residence, but are unable to sell their original main residence at or before the purchase price of the new residence. So for a sort of scintilla of time there, they are going to own two properties. And the good news there is, provided they're able to sell their original private residence within 3 years of purchase of the new one, then there won't be any 3% stamp duty land tax surcharge. The problem with this, though, is you have to pay the extra 3% up front and then recover it when you sell the original property within 3 years of purchasing the new one. That moves us on actually to the stamp duty holiday, which was originally announced by Rishi Sunak last year. And the position there is that it was due to expire at the end of March, but in his recent budget, he extended it. So basically, we've got no stamp duty on the first £500,000 of the purchase of a residential property until the end of June. Then it dips down to 250,000 until the 30th of September, and then it will resume to its normal figures. Now, that's really, really good news, because that rule applies to all purchases of residential property, irrespective of whether it's a new principal private residence or it's a buy-to-let. But don't forget, the 3% surcharge will still apply, so it doesn't exempt you from that. Right, so let's move on to now mortgage interest, because this was another area where George Osborne's proposal had quite a substantial effect. He announced in 2015 that over the next 4 years, higher rate tax relief on mortgage interest would be phased out. So it was phased out at 25% per annum until we got into tax year 2021, where you no longer got any higher rate tax relief on mortgage interest. All you would get is a basic rate tax credit on the mortgage interest you paid. For those people who have geared up to purchase a buy-to-let, this had an enormous impact. So I'm looking back to 2016 and 17 here, and somebody who had rental income of £40,000, and they were paying mortgage interest of £30,000 on the loan they used to buy the property. So you can see the gross profit there is £10,000. Now, back in 16-17, they would have paid higher rate tax, because it's a higher rate taxpayer, on the gross profit. So they would have paid 40% of 10,000, 4,000, meaning their net profit is £6,000. Now, if we roll the clock forward 4 years, so we're in our Doctor Who's time machine, and we look at the next slide, you'll see the impact this change will have had on that business. The rent's the same at 40,000, the mortgage interest is the same, the gross profit is the same, but the tax bill changes, because the tax bill is going to be 40% of the rent. So that's 40% of £40,000, £16,000. You can now knock off a basic rate tax credit, which is in effect 20% of £30,000, which is £6,000. So the total tax is 10,000 and the net profit is zero. So the change in the tax rules has completely eliminated the profit from that business. So this does have quite substantial effect. And the key points to take from this, as you'll see from the next slide, is that obviously there's no higher rate tax relief on mortgage interest now. You will get a basic rate tax credit, so you deduct that from your tax bill for the whole year, having done your tax calculation. But the other key issue here is we've got a little bit of crafty taxation by the Chancellor, because you can no longer deduct the interest from your total income. So somebody's adjusted net income is no longer adjusted for the purposes of things like the high income child benefit tax charge at 50,000, the personal allowance at 100,000, pensions taper, whether they're a higher rate taxpayer for capital gains tax and charge event tax purposes. So people will be paying more tax because of this change, which is not directly related to the taxation of their buy-to-let business. So anybody who's in that margin should very, very carefully think about tax planning to neutralise that. Going forward in the future, I suppose for some people, the attractions of borrowing to invest may no longer look so great. That's not always possible, but there are signs that people are trying to invest in property now without borrowing because of that change. You could purchase a property in the name of a basic rate taxpayer or non-taxpayer if you've got the choice. So the spouse, you've got a spouse there who's a basic rate taxpayer. Clearly, if he or she is doing the borrowing, then the impact of this higher rate tax change has no serious effect. Or the other thing that could be considered is to use a company to purchase the buy-to-let property. And last year we saw about 200,000 more companies set up purely for this reason. So why would people choose to use a company? Well, the fact is that if you're a company and you borrow money to purchase the buy-to-let, you can offset the mortgage interest against the rental income still for all tax purposes. Corporation tax is at 19% as opposed to the individual income tax rate of 40%, even up to 45%. But of course, corporation tax is scheduled to increase in 2023 to 25%, but that's only where you've got profits of 250,000. If you've got profits below that, you'll pay a lower rate of corporation tax. You can take income out of the company by way of dividend and use your £2,000 dividend tax-free allowance. You can include other members of your family as shareholders and pay them dividends. And of course, if you sell the property within the company, you'll pay lower rates of corporation tax than you might if you're an individual paying capital gains tax on a buy-to-let property you're selling. And estate planning is easier as well if you've got a company, because you can give shares away in the company rather than having to give bits of a property away, which can be a bit of a conveyancing nightmare. So there's lots of good reasons for using a company, but there are some points to watch on this. The first point is if the investor in the company, the shareholder, if you like, is relying on drawing all of that rental income out of the company and using it to live on. Because in that scenario, you could have double taxation. The company could pay corporation tax on the rental income when it comes in at 19% at the moment. And then if they distribute the net income to the shareholder as a dividend, that shareholder may well then suffer income tax on the dividend. And if he's a high rate taxpayer and he's used his dividend allowance, that'll be at 32.5%. So the overall tax bill there will be about £4,500, which means out of that 10,000 rental income, the client is only left with £5,468. So you've got a high level of taxation. So using a company to own a buy-to-let isn't good news if you're a higher rate taxpayer and you're relying on drawing all of that income out of the company as a dividend. To get round that, one way you could one planning route you can choose is to perhaps lend money to the company for them to make the purchase in the property. What will happen then is rent will come into the company and they'll pay their 19% corporation tax on it. But rather than paying a dividend out to the shareholder, they can repay a part of his loan each year using the rental income, and that will be tax-free in the shareholders' hands, the director shareholders' hands. So that's a more effective way of taking income out of the company if the circumstances are right. And an even more effective way, although it's fairly limited, is to get the company to set up a pension arrangement, because the shareholder will also be a director, and so the company would be able to establish an employer pension arrangement of up to 3,600 per annum and set that off against other income as a management expense. It's not massive, 3,600, but over 10 years, that's £36,000. And of course, with a pension, it's invested in a tax-free zone. So that could easily, over a period of, 10 years, increase to about 50,000, perhaps even more. Mark, what would you think there if you're investing 3,600 over 10 years?
Yeah, 10 years, it's probably going to be in that region. I had some clients that perhaps a little bit longer, but they've accumulated 100, 200,000, just by doing the 3/6s. 10 years, it wouldn't be as high as that, but it's certainly a tax efficient way of extracting profits.
Yeah, I think so, and it's surprising how quickly it builds up. Now, if we move on to the next slide, there are some disadvantages other than the one I've already highlighted. If you use a company for a new buy-to-let, you don't get inheritance tax business relief on the shares because it's not a trading company. Mortgage interest reliefs, if the company are borrowing, may be slightly higher, but those are getting better as mortgage companies realise that more people are using companies to purchase buy-to-lets. The alignment between the individual and the corporate mortgage rate is becoming closer. You've obviously got greater admin within a company and less confidentiality because you've got to do returns to the company's house. And you can, just picking out these other ones, you can get double capital gains tax on a property sale, once when the company sell the property, and again when the shareholder liquidates the company to get his cash or takes it out in the form of a dividend. So all these aspects have to be looked at. So that's really using a company for a new buy-to-let. There's been also a lot of interest, as you'll see from the next slide, of people who have got buy-to-lets at the moment and thinking, well, can we do any planning now to offset this neutralisation of higher rate tax relief on interest? Well, one thing they could look at, I suppose, is thinking about remortgaging and perhaps using an offset mortgage, which is more tax efficient than the normal repayment mortgage. Possibly transferring the property into the name of a basic rate tax paying spouse or to children, but you have got to be a bit careful there with the stamp duty and capital gains tax issues. You won't get capital gains tax on a transfer between spouses, but you could to a transfer to children. And another area to look at closely is if you've got property which is owned jointly between a husband and wife, and one's a higher rate taxpayer and one's a basic rate taxpayer, you can make a Form 17 election, which gives a higher proportion of the rental income to the basic rate taxpayer. That means that more of the income is taxed at a lower rate. Now, if you do that, you've got to remember that the ownership in the property has got to follow the income ownership, having made that election. And also that property will now be owned as tenants in common. So both of them would have to make a will, leaving their interest in the property to the other, because it wouldn't automatically pass to the survivor under the joint tenants approach. So that's something that can be, you can vary that Form 17 election from time to time as well. It's a very effective form of planning, very flexible form of planning. Then moving on, is there any scope to put properties, existing buy-to-let properties, into a company? Well, this has been a subject which has been discussed a lot over the last few years. The first thing you'd have to do is get permission of any existing lender to do that, and be cautious about schemes which purport to avoid that need by the owner keeping the legal title and giving away the beneficial interest, because I think some of those are quite fragile. The next issue you need to look at is capital gains tax and stamp duty land tax on the transfer of the property to the company. Now, this is quite a complex area of taxation. They do say that only 6 people in the UK fully understand it, and 5 of those are in mental institutions. So I'm just warning a little bit there. So if we move on to the stamp duty issue, well, basically the bottom line is if you transfer an existing buy-to-let property into a company, there could be stamp duty based on the property value and a 3% excess charge. Now, that is subject to the current concession that exists. So as long as your property doesn't exceed 500,000 in value at the moment, you won't get any stamp duty at the normal rates. You'll still get the 3% surcharge applying. Outside of the concession, is there any way of avoiding stamp duty? Well, the rules say, the legislation says that if the transfer is from a partnership, and that is transferring the property into the company, and that partnership has been running for, say, 3 or more years, then there won't be any stamp duty land tax. Now, I have to say here 2 things. First of all, the ownership of a property by husband and wife is not a partnership. It's got to be a lot more formal than that. To have a partnership, you really need a partnership agreement. You need to be doing tax returns. You need to have a tax coding, all of these things to show that that is a true, genuine partnership. And it's only if you've got that you'll get the stamp duty exemption when you transfer it into the company. So I would say, next slide, I think says exercise care. So if you're thinking about doing this sort of transaction, make sure you take professional advice. The other thing you have to look about on a transfer like this is capital gains tax. So when an individual transfers his property to a company, that will be a disposal for capital gains tax purposes, as you'll see for the next slide. And there could be capital gains tax on any capital gain that has arisen to that date. Now, to avoid that, you could claim incorporation relief. This is a special relief which defers the payment of capital gains tax. And the way incorporation relief works, as we'll see from the next slide, is that when you transfer the property into the company, the individual would normally, in return for that transfer, get a shareholding in the company. And that shareholding would have an acquisition cost equal to the value of the company on that date, which would normally be the value of the property in this case. If you can claim incorporation relief, though, what will happen is you won't get a CGT charge on the transfer of the property to the company at that time. Instead, that capital gain will reduce the deemed value of the individual's shares. So rather than having shares acquired at 100,000, he'll have shares acquired at 50,000. So obviously when he sells those shares or liquidates the company, that 50,000 capital gain that arises now will then come into charge. So this is a means of capital gains tax deferral. Now, in order to obtain incorporation relief, you have to satisfy a number of conditions, and these are set out in this slide here. And the main two conditions, I think, are that this property ownership, this property investment must be operated as a business by the individual who's transferring the property to the company. So what do we mean by business? Well, we had a legal case about 7 years ago where this was examined by the special commissioners. And they said in that case that if the individual is spending at least 20 hours per week, I don't know why it says 20 weeks, but it's if the individual is spending at least 20 weeks a year in looking after this business and managing it, then they will treat that as a business for incorporation relief purposes. Right, so I'm just going to revise that. Okay, so this slide, I'm sorry, it's incorrect. The test there is 20 hours per week. Okay, that's what they decided in the Ramsey case. So if a person was working in that property business and devoted 20 hours a week, that would be treated as a business. Now, that's not a hard and fast rule. That was what was said in this particular case because Elizabeth Ramsey was spending that time. So it may be that you're not spending all of that time working in the business, but you're still treated as a business. But it's clear that the more properties you own, the better. So if you're transferring 5 properties into the company, then you've got more chance of claiming that this is a property business than if you've just got 1 property that you're transferring to the business, where that would probably be just treated as an investment. Okay, so it does depend on the facts of the case. And if you can satisfy that business criteria, then hopefully you'll be able to get incorporation relief. Right, moving on, there's another tax charge that can apply when companies own properties, residential properties, and that's ATED. That's the annual tax on enveloped dwellings. And it basically means that if a company owns a residential property and that property is available for somebody who's connected to the company, so a director or shareholder, then in those circumstances, there'll be an annual tax charge on the company, and that's called the ATED tax charge. There are some exemptions to this. For example, if you own a prison, you won't be subject to ATED. If you own a hotel, guest house, all of these won't be subject to the ATED charge. And the ATED charge can be quite high, as we'll see from the next slide. So if you've got a company that owns a property which is worth 2 million, you're looking at a £25,000 annual tax charge based on the tax rates last year. When you're looking at this, you only have to value the property every 5 years. So that 5-year valuation, will see you good for the next 5 years. Right, now there are some other important exemptions, and this is the one which is key to what we're looking at here in the buy-to-let market. And that is that there's no ATED charge if the property is let commercially to somebody who's unconnected to the company, as in most cases it will be. So we can be reassured to know in most of our cases where the company owns the buy-to-let and it's let out, there won't be an ATED charge. The point to watch there, though, is you still have to register for ATED, even if there's no charge. If you don't register, then you'll get a penalty applying. Okay, so it's important to register even though you know there's going to be no charge. Okay, so that's the ATID charge. Let's move on now to capital gains tax. For these are the people who have invested in a buy-to-let and are perhaps looking at long-term capital growth on that buy-to-let and perhaps cashing in on that in their 50s, late 50s, early 60s to realise a substantial capital gain. Now, of course, what they're going to be interested in then is the potential capital gains tax liability on the sale of that buy-to-let property. And capital gains tax has been in the news quite a bit recently. In the run-up to the budget, there was quite a bit of expectation that the rates of capital gains tax would be increased. So I'm going to comment on that in a minute. And first of all, I'm just going to go through the basics of this. When you realise a buy-to-let property, how do you work out your capital gains tax? Well, you determine the capital gain, which is the sale price less the purchase price of the property. And there's also other deductions you can make for other expenses, solicitor's fees, stamp duty, and so forth. Subject to that, if you've got a capital gain on your buy-to-let property, then it will be subject to tax. But before you do that, you can knock off your annual exemption of £12,300. That applies in this tax year, and that has now been frozen through to tax year 2025-26. So that annual exemption won't be increasing. You then add the gains into your taxable income, and if they fall within your basic rate tax band, you'll pay 18% on those gains. And if they fall within, well, if they fall over the higher rate tax threshold, you'll pay 28% in capital gains tax on those gains. Even if you're an additional rate taxpayer, you'll only pay 28% on the capital gains. Okay, so just before we move on, I need to say as well that, of course, if you're selling your principal private residence, you've got a CGT exemption on that. And the way the tax rules operate is that they channel that exemption through into situations where you've occupied a property as your principal private residence and then you've let it out. So we get this thing called lettings allowance, which means that a certain part of any capital gain will be free of tax if you've previously occupied the property you're selling as a private residence. And of course, we've got this 18-month rule, which says that if you've occupied the property you're selling as a private residence, albeit you're not now, but you have in the past, then when you sell it, the last 18 months of that ownership of the house will be treated as a period of residence. So when you're working out your principal private residence exemption on the capital gain that's arising, it will be higher. Now, there's been some important changes in these areas over the last year or so. First of all, we've now got a restriction of the lettings allowance, and that will only apply to periods of time when you've occupied the property as a private residence and at the same time you've let it out. Previously, you could have concurrent situations there. So a lot of people won't get lettings allowance now. And we've also now got a reduction of that 18-month deemed period of residence down to 9 months. Added to all that, you now have to pay capital gains tax on the sale of residential properties within 30 days. You no longer wait and pay on the 30th of January in the following tax year. Now, as an example of how these rules have impacted on capital gains tax, we've got Mr. W purchased Ivy Cottage for 100,000 in 2010. He's lived in it till 2015 when it was worth 170,000. He has then let it out for the following 5 years till in 2020 he sells it for £200,000. Now let's look at the capital gains tax position on that transaction in 2019-20. Well, without going through these figures in detail, you'll see that the principal private residence exemption is 65,000, the lettings exemption is 35,000 based on the old rules. So there's no taxable gain. Now compare that to 2021 and you'll see that because the 18-month period has gone down to 9 months, there's less principal private residence on that exemption on that gain. Also, this particular person will get no lettings exemption because of the fact he hasn't lived in the property at the same time it's been let out. So you can see that he has suddenly, overnight, got a 30,200 capital gain, taxable capital gain, whereas previously he didn't. So these rules have come in and they are punishing people who are selling properties which have got some sort of residential value and increasing the taxable capital gain that will then apply. Right, next slide, please. Now, I said a moment ago that there was quite a bit of speculation that capital gains tax may be changed in the budget. And that is really because of the mismatch in the rates of income tax and CGT. You've got a 45% top rate of income tax, and you've got a 20% top rate of capital gains tax, at least on the sale of shares and investments, and 28% if it's the sale of a residential property. So Rishi Sunak asked the Office of Tax Simplification to look at CGT and provide a review. And one of the areas they looked at was possibly a closer alignment of the rates of income tax and CGT. And what it does mean is I think that people who are thinking about selling assets over the next 3 or 4 years have got to take a view on whether there may be some changes in the CGT rates. We didn't see this in the last budget, but clearly we've got another budget scheduled for the autumn. So it may be that changes will be introduced there. So I suppose if you're thinking about selling an asset now and you've got a nice profit on it and you're comfortable with a 20% rate of capital gains tax now, it may be worth taking action sooner rather than later. I mean, that's a commercial decision. From a tax standpoint, I think it's only a matter of time before rates of capital gains tax increase. One other way of planning for capital gains tax is to use the CGT exemptions of both husband and wife, putting assets into their joint ownership. That won't give rise to any CGT because of husband and wife. And then on sale, they both hopefully have a 12,300 annual exemption. Spread sales of properties over different tax years to maximise the use of CGT exemptions and lower rates of tax, and possibly use EIS reinvestment relief. Now, I don't know whether you know very much about the EIS scheme, but an EIS is basically an investment into a fledgling trading company. So you'll see from this slide that if you invest in an EIS, you will be able to, one of the benefits of it is that you can claim reinvestment relief from a capital gains tax standpoint. So what the government are doing is they're trying to encourage people to invest in EISs because this is a way of stimulating fledgling companies, fledgling trading companies. And the way they do that is to offer these tax concessions. And one of these is CGT reinvestment relief. And basically it means if you abide by the rules in terms of dates of investment, if you invest an amount equal to a capital gain into an EIS, then you can defer the date you pay CGT on that capital gain until the date you sell the shares. Okay, so it's a form of capital gains tax deferral. So here's a little example for you. So we've got Mr. W, he sells a buy-to-let property in this tax year and realises a chargeable gain of £212,300. He can knock off his annual exemption of £12,300, so his taxable gain is £200,000. Now, normally he pays CGT on that of £56,000 because he's a higher rate taxpayer, so he'd pay the 28% rate of CGT that applies on residential properties. And that CGT technically would be due on the 31st of January 2023, but these days you've got that new 30-day rule, which means he'd have to make a payment on account of that capital gains tax within 30 days of completing the sale. So what he could consider doing is investing that an amount equal to that gain into an EIS. The tax implications of that is you get tax relief at 30%, that's £60,000 of tax relief up front. If he hasn't got a sufficient income tax liability of 60,000 this year, he can carry back some of the investment and set it off against last year's income tax bill. He'll also get capital gains tax deferral, so he can avoid paying tax on the 200,000 gain now by making an election. And then he will pay CGT when he sells the shares in the EIS scheme, and he'll either pay at 20% or 28% at that time. He also gets the benefit of inheritance tax business property relief of 100% once he's owned the shares for 2 years. So they'll be outside his estate completely for inheritance tax. And of course, if he were to die in the meantime, then under the current capital gains tax rules, all of the existing capital gains in the shares would be washed out. So that £200,000 reinvested capital gain would disappear on his death. But don't forget, with an EIS, although there are these very important tax reliefs, it's a risk investment. So the client needs to realise that when he's investing in one of these, it's not necessarily all a bed of roses. One thing I would say, though, is if the EIS does fail, the loss relief is available, and that can mean that any loss that's been sustained can be offset against income tax liabilities in the tax year in which the loss occurs. So that's basically a good form of tax deferral with an EIS. That leads us on to, I suppose, the next question is, should you use property or pension as your retirement provision? Well, I've looked at the tax implications on property, so let's have a quick look at the situation on pension. Well, if you pay into a pension plan, you get upfront tax relief on amounts paid within your annual allowance, which is £40,000 at the moment, but you can carry forward from the previous 3 years if you haven't used all your relief in those years. And that money will then be invested in a tax-free fund. Next slide, please. When you wish to draw your money out of the pension plan, you can take up to 25% of its value as a tax-free cash sum. The balance, if you draw it out, will be taxed as income. Quite often people these days go into income drawdown, so it sits there, so they've got some flexibility as to how they take that money out. Don't forget, we've got a lifetime allowance limit of about 1.1 million, and that's frozen for the next 5 years. So any lump sums you take over and above that will suffer 55% tax or 25% tax if the fund is designated into drawdown. No capital gains tax on pension plan, obviously capital gains tax if you're selling a property. And then on death, with a pension, there's no inheritance tax, but there can be income tax on death benefits that are paid after age 75. With property, the value of that property will be in the investor's taxable estate. So Mark, I think you were just going to give a bit of an overview of this situation, weren't you?
Yeah, very briefly. Conscious of the time, but I think, John, you've done an excellent job just setting out the landscape. I very often say to clients, no one product is or asset is the panacea. Property, pension, cash, investments, those are typically the quadrant that I look to. I think in this instance here, you can see the complexity of property, and if commercially you've got to do it, then that's great. You do it, but with the pension, it is a little bit more straightforward. So effectively, you've got an asset that is gross and sits outside of your estate. So you're avoiding all the capital taxes, certainly on entry, until you exit. And even on exit, you haven't got corporation tax to pay. You haven't got, all the sort of different leakages that could take place from that. So if you were just simplistically going to, look at a property portfolio of £1 million, if you were to compare it against pension, well, the pension would obviously give you, if you could buy a property that the government would give you 40% tax relief on, and also give you another 25% off that capital value to bring your net cost down effectively to 35% of that property portfolio, would you do it? That's essentially what you have with a pension. It's the reliefs that are there are very attractive. If you die before 75, as John has just said, there's no inheritance tax. So you've avoided income, capital gains, and inheritance tax. So really, I think moving forward, as John has alluded to, pensions certainly need to play a stronger place in somebody's portfolio, and effectively use the flexibility. Property, of course, is notorious for its illiquidity. That's the right word. Not very liquid. Pensions have that flexibility. You can, and I have clients who have synthesized, if you like, both. You can have a commercial property within inside the pension, and that's something that is certainly worth doing if you're an owner manager of a business. The tax efficiencies of that, again, the rental income being in a gross environment, but you do have that liquidity issue again. You just have to be conscious of, i.e., when you come to the exit, how do you get your tax-free cash out? Well, you have to navigate through that with some planning, possibly have to sell the property, etc. So just a very whistle-stop review of the options there between property and pension. Thanks, John.
Yeah, and I would say that even if you invest in property, there are still reasons to do a pension alongside that. You know, you shouldn't put all your eggs in one basket, you know. So just into the last couple of minutes then. So the next slide, a question that quite often comes up is, how do I help my children buy a property? And I suppose there you'll see from the slide here are the options. The options are the parent could provide a guarantee on any mortgage payments. So if we just move on to the next slide. Or the parents could buy the property in the child's name. We've seen a few cases recently where parents have purchased property in the child's name, and then later, when they fall on hard times, try to get some money back out of the property on the basis they had some sort of interest in it. So I'd suggest that you document these arrangements very carefully. Parents, if they want complete control, can buy in their own name, or the parents could establish a trust to buy the property. That sometimes works quite well because it means the parents have got control, but the value of the property, the interest in the property, is earmarked for the children who are the beneficiaries under the trust. And moving on then to the last little bit, which is basically inheritance tax planning with residential properties. So if we move on to the next slide, how you plan depends on the type of property you've got, whether it's a principal private residence, a buy-to-let or a holiday home. It's pretty difficult to do inheritance tax planning with a principal private residence unless you're prepared to gift it away and pay a market rent. Let's concentrate on the buy-to-let there. So if you're making a gift of a buy-to-let during your lifetime, so you get into your 60s, you don't need the income from the buy-to-let anymore, you don't need the capital, it's sitting there, it's just adding to your taxable estate. What can you do in terms of lifetime gifts? Well, the 4 key issues you've got to look at are capital gains tax, inheritance tax, how much security control you need, and whether you need any access to the income, the rental income in that buy-to-let, or its capital value. So let's assume first there's no capital gain on the property. So it's a relatively new property, or perhaps it's been fairly flat in terms of capital appreciation. Well, there, the individual could make an outright gift to the next generation. That would be a potentially exempt transfer. There's no inheritance tax then, irrespective of the value of the gift. No capital gains tax because there's no gain. But the one drawback there could be control, because clearly the parent there has given up complete control of the buy-to-let property. A way around that, if you'll see from the next slide, is to use a trust. So the owner can declare a trust. Here's the trustee. The children are a class of discretionary beneficiary, and that works quite nicely, provided the individual doesn't go over his inheritance tax nil rate band, which is 325,000, 650,000 for joint owners. Because if you do that, because this is a chargeable transfer, you'll have 20% inheritance tax on the excess. Now let's move on to the next slide and consider somebody who's got the more likely scenario of a buy-to-let property with a capital gain on it. Well, there, if you give that property away, that's a disposal for CGT, so realise a gain which could be taxable in the way I've described. It could be up to 28% tax. But one thing you could consider there is using a mechanism for holdover relief. So in the next slide, you'll see holdover relief is a way in which you make a gift to a trust, which is a chargeable transfer for inheritance tax. That's like that discretionary trust I mentioned. And rather than pay immediate capital gains tax, you defer the gain. So the gain is deferred until the trustees sell the property or until they transfer the property out to beneficiaries. And even then, when they transfer it out, there may be another chance for a holdover election. Okay, so this is a good mechanism of passing a buy-to-let property down through the generations using a trust. So if we look at the next slide, but again, it's very important that the individuals don't go over their nil rate band, because you'll get a 20% tax charge on any excess. And the other thing to bear in mind is that this is not good planning for somebody who's very old or in ill health. Because you've got a deferral of the CGT, you're throwing that gain onto the next generation. Whereas if they kept the property and they died, that capital gain would be wiped out on death. Other than that, the benefits of a discretionary trust are quite useful in terms of property transfers, because as well as the tax benefits, there is protection against divorce claims, say, of children, or children becoming insolvent, because the property is held in the trust and the parents are the trustees, so it wouldn't be used to meet any of those divorce claims. If you're worried about the income tax on rental income, there are different types of flexible trust you can use to overcome that, typically a thing called an interest in possession trust. And just finally then, there's going to be cases where people want to make a gift of the property but to keep the right to the income. And in very brief terms, this is quite difficult to do, because if you keep the right to the income, the gift with reservation rules will apply, which will mean that the property still is regarded as being in your estate for inheritance tax purposes. Schemes do exist, but these days you've got to be so careful with using these types of schemes. There is one, actually. There's a loophole in the next slide, please. In the can you build it up for us, please? Yeah. In the Finance Act 1986, which means that if you give away a share of a property to somebody else, you can still continue to enjoy all the income from the property, including the share you've given away. Okay, because you're giving away an undivided share in the property. So by giving that away to a trust under which you're a beneficiary, it seems you can get around the gift with reservation rules. The problem you'll have there is capital gains tax if there's any gain in the property or the share of the property when you give it away. So you need to just exercise a little bit of caution when using, well, a great deal of caution, I say, in using these schemes. So in conclusion there, I think property will always be of interest to a number of people as an investment. Even though the tax rules are harsher, people are still quite interested. Buy-to-let will be seen as an attractive investment for many, particularly in retirement planning. The key is to be a bit shrewder about your approach to holding properties in order to combat some of these tax changes. And the planning you need to undertake depends on your circumstances and objectives. Everybody's different. As part of our approach to this, we have introduced a property investment advice service. So if we just move on to the next slide, and this is designed to give people who have got property portfolios some sort of advice on the structure and taxation of those property portfolios. So basically, part of this service involves getting a questionnaire completed by the property owner, which sets out all the facts and the details of the property ownership, the rent they receive, the interest they pay, the ownership and so forth, as well as getting other information about the client's finances. And what we will then do is appraise the current position and look at ways in which that property ownership position can be improved. And we'll then go back and give the individual a confirmation letter which sets out our understanding of the circumstances of that particular individual, and more important, or equally important, the objectives of that individual. And provided the individual is happy with that, they can sign up. There's a client agreement they have to sign, and they will in effect subscribe for an all-embracing property report that we will supply. The cost of that is £1,950 plus VAT. It sounds quite a lot, but I think a lot of people appreciate that report for just giving them a snapshot of where they are with their property portfolio now and things they should be doing to improve the tax position. But I think we would be flexible depending on what the objectives are. If somebody's just looking at inheritance tax planning and not the other bits and pieces involved in income tax and capital gains tax, we would be flexible about the fee we charge. So that really brings me to an end. Pass back to Mark.
Yeah, thanks, John. That's been very comprehensive, and I think it did what we said on the tin. We just wanted to alert people to the issues in a very steady way. You've taken them through. The details there on the screen for those that obviously want to pick up any questions with us. We're available for the next few minutes after Ian closes off, of course. But hopefully today you've just seen what we can offer BACFI members in terms of the support and giving them the financial planning advice over the next few years. Thank you, Ian.
Yeah. Thank you, Mark and John. That was a very clear presentation and a very good illustration of the tax issues that you need to consider, both pensions as well as property. So thank you very much for that. It was very informative. And what I'm going to suggest is that after I've finished, I'm sure Mark and John will stay on to answer any questions for a few minutes longer.
Yeah,
Sure.
yeah.
That's good. So just to remind everybody that we've got a couple more events coming up in May. We've got an event for young barristers and students called Demystifying the Employed Bar, which I think you'll find very interesting. And we've got a number of practicing employed barristers who will be talking about their careers and the opportunities there are at the employed bar and the different jobs that you can do. And then the week after, we've got another in our series of looking at inclusion and diversity at the bar, which all these details are on our website and are advertised on Bar Talk. So we look forward to seeing you all on those webinars as well. So once again, thank you, Mark. Thank you, John. It was a really good presentation, and I'll leave you to take any questions from the floor. Thank you very much.
Thanks, Ian. Yeah, well done, John. So, any questions from anybody? I know, Sandra, you've got a buy-to-let that you've just inherited, Sandra. Is that correct?
Yes, we're just sorting it out at the moment. It needs lots of work, so we're just just organising everything.
Yeah.
So I'm quite looking forward to it, though.
Yeah. No, I think it's what we meant by the accidental or the reluctant landlord.
Yeah, we'll see how it goes for a year or two and go from there, really.
Yeah, good. Have you had many, John, that have actually come to you through the service?
Yeah, quite varied as well. We've had cases where there's individuals who've just got sort of 3 buy-to-lets, and we've had cases where they've got sort of 50 buy-to-lets in husband's name, wife's name, and in companies' names. It's quite varied, and also different objectives as well. Some are just looking to improve the tax efficiency of their current portfolio. Others are actively looking at selling and mitigating capital gains tax. And quite a few more recently where people have sort of drifted into their 70s, have got these buy-to-let properties and now don't really know what to do with them, so they're thinking about inheritance tax and how they can transfer them down to the next generation to avoid inheritance tax. I think this typically does happen quite often. You acquire a property, perhaps in your 40s, and you think, oh, that's a good thing to have. And then suddenly you're in your 60s and you're thinking, what am I going to do with this going forward? So very varied, actually. Yeah. And quite a lot of interest in forming property limited companies as a means of not saving tax on rent and stuff, but as a means of transferring shares onto the next generation, and having control over when people get those shares, which is a difficult thing to do if you just own a property.
Yeah. No, I think it's it's true. I know in my situation, my own portfolio, it's not necessarily easy to divide it up amongst just your children as well. So you can see a corporate structure might lend itself, mightn't it? Giving away shares, as you say, rather than splitting the property up.
Yeah, and the good thing is that the corporation tax rules that are going to change in a couple of years. The Chancellor announced the corporation tax
25%, yeah.
And he's still talking about keeping the 50,000 19% rate. Profits up 50,000, tax at 19%. But if you've got a close investment company, so you've just got an investment company, the thinking is you're going to just be charged 25% on everything. But a property company isn't categorized as an investment company, so you'll still get the 50,000 lower rate tax band, the 19% band, which is good news. So property companies won't be particularly punished under that change, which is good news, I suppose.
Yeah, and indeed, just thinking about what you said about basic rate people as well on buy-to-lets, they're not necessarily impacted that much with the changes that have happened in recent years. So again, if you are able to sort of do planning around that and keep it simple, then you might be okay. I think the issue is inheritance tax, ultimately. It's very easy to fall into it, but exiting out of it is the challenge.
And don't forget, in the budget, the personal allowances and the basic rate band have been frozen for the next 5 or 6 years. So more people will naturally fall into higher rate tax
over time.
Even if their income increases only, by inflation, it's gonna, a lot more people will, they reckon another 1 million people, I think, over that period will become higher rate taxpayers.
Yeah.
Without necessarily earning any more in real terms.
Yeah. Stealth. Yeah.
Yes, it is.
I think one thing we have noticed on the commercial side, commercial property through pensions, I didn't really have time, perhaps we can do a separate session on it, but quite a few barristers' chambers use the SIP and commercial chambers within their SIP to get the tax efficiencies moving forward, but time didn't allow us today to go through that, but hopefully we can do that on another occasion. But I was speaking to Claire Trott this morning. She said it's very complex, but barristers have an appetite for it, so I think we might have a session just talking through the efficacy of that.
Well, if there's anybody who can deal with the technicalities, it's going to be a barrister's chambers, isn't it?
Indeed.
Unless it's criminal law, they do, I suppose.
Yeah. Well, if there's any other questions, if not, thank you ever so much for attending. And you've got the details on the screen. And please feel free to approach Sandra or Ian, etc. if you want to get hold of either John or myself. Just have a bit more